No need to tell you, October has been full of wild market gyrations. My next guest, Daniel Arbess, CEO of Xerion Investments, is asking if the sell-offs are being amplified by investors' growing reliance on program trading. In a new op-ed in the Wall Street Journal titled, "Investors Look Up From the Algorithms, Virtualization Means the Old Strategies May No Longer Apply. How to Adapt? Use Common Sense." He goes on to write, "Trading algorithms primarily use detective logic, extrapolating the future from past patterns, but past performance is no guarantee of future outcomes. Some of the assumptions that drive passive trading strategies may no longer fit the conditions of the information economy." Daniel joins me now. Got a lot of buzz on this article, Daniel. Congratulations.
Thank you.
So for folks watching, and you know, a few years ago there was a book out, a negative book about high-speed trading and program trading, and it got a bad rap by average individual investors. When you see a session like yesterday, up 350 on the Dow, down 550, closing down 250, people are saying, there goes those machines again. What do you say to them?
I think there's probably some legitimacy in that because, as a point of fact, J.P. Morgan recently observed that less than 10% of trading takes place with human decision-making. The rest is passive or program trading. And the trading by algorithms has to run according to certain assumptions. So the question is, are the assumptions relevant? Algorithms, as far as we know, and I've done a lot of work on algorithms themselves, although not in fintech, but in the broader context. The definition of an algorithm is a method of making a decision. The method depends on the assumptions. Algorithms are very good in the financial context at capturing patterns, historical patterns, and moving decisions in line with those patterns, but they are not yet evolved to the level of full neural networks that can anticipate where things are going. And so if the algorithm assumptions are out of step with what's really happening in the economy, you get a divergence, which for somebody like me is a great opportunity.
It's for someone like you, a professional, it's a great opportunity. For someone at home, it's nerve-wracking and they may bail out. And the question is, can these algorithms be manipulated, knowing that they may make certain assumptions based on certain things, whether it's selling, begat selling. We see how quickly it feels like some programs trigger other programs, and they trigger other programs.
Absolutely, yeah. Because they pick up signals and they amplify the signals. So algorithms are like a pendulum that swings the market to the ends and back very quickly.
But you're okay with them, though, right? You don't mind their existence.
They are what they are. I'm not particularly interested in revamping the market realities. I'm interested in living with the realities and taking advantage of opportunities that are presented by them. So I think about, what are the fundamentals telling me? When I get up in the morning, what do I see? Does interest rate normalization and the end of the benefits of tax cuts, is that a bad thing for markets? No, it's a good thing for markets because we're removing forces that have been distorting the markets for the past 10 years. Now we can look at things on the merits. Higher rates, is that the end of what people here have called, in your last segment, growth? No, the growth is being driven by structural, secular changes in the economy. These companies that have gotten beaten up after reporting excellent earnings, Google, Amazon, we're going to hear Facebook and Apple,
right.
All of these names, the FANG names, and more importantly, the FANG analogs in China, which I call the bait stocks, China's a whole different topic, are excellent names. They have cash-laden balance sheets. So they don't borrow money. They're not sensitive to interest rates.
But the fact of the matter is they've been hammered even more so than our tech names have been.
That's what you call an opportunity. Why is that an opportunity? Because they have utility-like characteristics in relation to their customers' loyalty. Their businesses are continuing to grow. Their revenue growth is going to moderate over time, as does the case with all companies that mature, but their profit margins are continuing to grow and accelerate. They're a buy. They're not a sell.